Right, good morning, then, everyone, as we head into trade for the European session on Tuesday, the 11th of July. We're going to look in the markets, we'll see what's going on, we'll see what's up, what's down, and what we can figure out over the course of the rest of today. You can see a couple of things over here. Asian shares rise, investors eye end to Fed hikes and then Chinese stimulus. So Asian shares rose and the safe haven dollar edged lower on Tuesday as investors hope this week's US inflation data supports an imminent end to rate hikes and cheered the prospect China will deliver economic stimulus to prop up stalling growth. Now, we did mention a couple of weeks ago that the Chinese, the central bank, were not going to lend so much support. It was going to be the Chinese government that were going to lend support to targeted sectors of the economy in order to prop up an economy that is stalling. And one of the first measures that they've obviously released is towards has happened over the course of tonight, or this morning, should I say. So that is likely to continue. You're likely to see a few more bits of support lent to the economy. Obviously, you can see property shares have enjoyed the targeted stimulus measures, which have been targeted towards the building sector, the construction sector, over the course of this morning. But that's likely to continue on in other sectors of the economy as we go on through the coming days, weeks, and possibly even months to battle the faltering economy. You can see dollar retreats as Fed signals rate hike cycle nearing its end. Now, the dollar weakened on Tuesday after Federal Reserve officials signaled that the central bank was nearing the end of its tightening cycle, which is no surprise. I mean, we're up over 5% interest rates. They're hardly halfway through it, are they? So not really too much sort of fresh headlines, and I mean, it's kind of, what else are they going to say? As I said, they're not going to say they're halfway through. They're going to go to 15% or something and triple the interest rate. I mean, that's clearly not going to happen. So it doesn't take a genius to work out they are approaching the end. When the end is, though, is another question. And obviously we need to look towards tomorrow's inflation print to see if we can get any further clues on when the end actually may be. Oil rises and OPEC cuts. We were speaking about OPEC cuts on oil yesterday. Traders focus on supply cuts by the world's biggest oil exporters, Saudi Arabia and Russia, and the weaker dollar. I'll jump across to the chart now in a minute. They're not exactly massively higher, but we have seen oil come from 67 up to 72. So pretty solid move in oil over the course of last week and this week, especially when you take into consideration that we saw such heavy stock index downside, and last week we saw a pretty heavy oil upside. So that's a positive for the price of oil off the back of kind of Saudi Arabia oil cuts, or supply cuts, should I say. And we've had a couple of weeks in a row of draws on crude oil inventories out of the US. So a reduced supply of oil, naturally reduced supply of anything, causes the price to rise. Apart from that, that's kind of where we're looking at. I mean, some wage growth figures out of sterling. Now, sterling hits 15-month highs. Wage growth heaps pressure on the Bank of England, right? Now, we'll jump across to the calendar in a minute and we'll have a look. But obviously, when wage growth remains strong at the moment, then that means that it continues to put a slight bit of pressure on inflation. Obviously, then that continues to put pressure on the Bank of England, but the Bank of England won't like that. They won't like wage growth increasing. Causes them a couple of headaches. But from a people's point of view, people struggling with the cost of living, people need higher wages in order to be able to deal with that. And Bank of England will say that creates higher inflation, but prices are too high for a lot of people to deal with, so they need higher wages. So kind of a bit of a catch-22 scenario where it's a little bit tricky to work out what's best, but people need more money, and that's what they will try. And that's what they will try and get. You can see equity futures across the board green to start the day off the back of these Chinese stimulus measures. Obviously, the property market is the large component of the Chinese economy, so targeted stimulus measures in order to prop up that sector of the economy is obviously a large positive for China itself. Now you can see the Hang Seng up over 1%. You can see the rest of the stock index. You can see US, European, Asia Pacific stock indexes all higher across the board. No matter where you look, you come around to your commodities where you're looking at oil, gold, silver, copper. These are all higher as well. Your bond yields are down, right? US yields are down off the back of dovish comments from the Fed yesterday, suggesting that they're at the end of their hiking cycle. We'll jump across to a chart now in a minute, and we'll have a look. US dollar pretty weak across the board. Those moves across equity futures are not being replicated across the FX space. See the Japanese yen, strongest currency across the board, which again is of note, that continues to be strong. Every time you look at this grid, or certainly every time I look at this grid, the Japanese yen is the strongest currency on the day. And that is now nothing to do with risk sentiment. It's nothing to do with stock markets being under pressure. You can see stock markets higher across the board. Japanese yen now is also higher across the board. So that is a Japanese yen move. Not unsurprising given the widespread weakness we've had across the currency over the course of the year. You can see the percentages that the currency is down year to date. Obviously, double digits on a number of them, which is obviously which was getting to a point where it was becoming a negative for the Japanese economy. With that approaching 145, it did reject $145 yen, around 140.150 on one of these videos. When we looked at it yesterday, we are now at 140.70. So that move continues to push lower, nearly 450 pips move lower off the bounce off 145, which we were looking at that time. Apart from that, it's really where we are at. Again, risk sentiment not being relayed across into the Australian dollar, Kiwi dollar, Canadian dollar. You can see oil up 0.5%, not really being replicated across the Canadian dollar as we head into the Bank of Canada yesterday. Into the Bank of Canada yesterday, into the Bank of Canada tomorrow, should I say, which we'll obviously update further as we get into it tomorrow. Across to the charts, and you can see, if I go back to this news for a second, that's why you got to be slightly careful of the news. Where am I here? Although it traded in a tight range ahead of a key US inflation report. So they're talking about the dollar, right? Although it traded in a tight range ahead of a key US inflation report. Article's only 39 minutes ago, but to me that doesn't really seem like a tight range. Have a look at this, selling off before that. You can see obviously euro dollar, you can see cable, you can see dollar Swiss, dollar yen. That's not really exactly a tight range. I can see what they would say the Australian dollar, the Kiwi dollar, trading in a range, but it's still a 100 pip range. It's not exactly a tight range. I suppose it depends what time frame you look at it on. But clear US dollar weakness into this CPI print tomorrow. Now that was obviously helped along by those dovish comments from the Fed yesterday, or from Fed officials yesterday. Now as we head into CPI or US CPI tomorrow, those comments were not predicted by markets. That's just what they ended up saying. But you can see the sentiment on a number of these things was weak US dollars into that US CPI report yesterday. Now you had some weak job figures, weak NFP prints on Friday. If that relays into some weak inflation prints tomorrow, plus then a dovish Fed yesterday, that goes in line with the Fed approaching the end of the hiking cycle. Is that a situation where we get one more and done? Obviously, it remains to be seen. Yields do not like it. We were speaking about yields back below 4% and how that would be negative for dollars and positive for stocks. We were also speaking about how if this 2-year yield continues to push lower at a faster rate than this 10-year yield, again, that is a more normalization of the yield curve, which is then a positive for risk as well. So welcome developments in terms of positive risk. You can see the S&P 500 has quite clearly enjoyed those developments overnight. It continues to push higher, pushes to fresh highs today. And that big downside from last week looks set to be reversed, or looks on its way to being reversed, certainly as we head into that US CPI print tomorrow. Aussie yen, CAD yen continue lower, clear Japanese yen strength, which we were speaking about a little bit earlier. Gold, we're back above 1930. Now, we've spoken about gold for a while. Off the back of interest rates continuing to rise, gold continues to be pushed lower. Now, the fact that interest rates are being pushed back on, and they're talking about stopping interest rate hikes, a couple of developments over Friday, yesterday, and then into tomorrow, which could definitely signal the end of interest rate hikes. That is then an environment where this gold chart then pushes higher. You look at these technicals where you got a left shoulder, head, right shoulder, and I think as that tide starts to shift, gold longs seem a more attractive proposition than they did a week ago. So if that continues higher now up through this, your options are kind of a break and a retest of this level in there, or to wait for a break of this little trend line, get above that. Certainly up towards 1970 seems a decent target. So weak inflation tomorrow, I think gold upside seems a decent bet to go with in terms of terms of trading that. And then that brings us on to stock indexes, which are also a decent bet off the back of some weak inflation prints. Now you can see the S&P, the Dow, the Nasdaq all bouncing back from last week's sell-off. The Russell has already reversed it and is up back towards post, or is making an attempt at breaking above highs from last week. Technically, we've popped our head above it. Does that continue into next week, or into the rest of today and into tomorrow? We'll have to see, but certainly Russell having a good time. But at the moment, the DAX is even grinding higher now. FTSE, I mean, wage growth probably continue to put pressure on the FTSE, so maybe the FTSE gets the odd one out. FTSE gets left behind when we get this rally up, or as we get this rally up. But certainly the DAX making an attempt at pushing higher. FTSE and the Nikkei remain slightly under pressure. Now the Japanese yen pushing higher, Japanese 10-year yield also pushing higher. Expectations potentially for the Bank of Japan to alter their yield curve control. That's a situation that is negative for the Nikkei. So the fact that the Nikkei is not pushing higher means that if the US stock indexes do turn lower, maybe bond yields start to push higher in the US, as maybe likely to be a negative for Japanese companies. Apart from that, onto the calendar today, we can see average hourly earnings including bonus, actual 6.9, up from 6.8 and up from a previous of 6.7. So positive wage growth figures. The unemployment rate has risen slightly, but the fact that people are earning more money has seemingly offset that weaker unemployment rate. Now unemployment rate rising, probably a slightly welcome development for the Bank of England, which is a pretty crazy thing to say, but that will help with the cooling down of the economy. But average hourly earnings including bonus did rise over the course of this morning. German CPI bang in line with expectations. Westpac consumer confidence bang in line with expectations. The consumer confidence index bang in line with expectations, and the business confidence slightly higher, but nothing to spark any sort of movement across the US dollar. We have some economic sentiment figures out of Germany, which, if they come in weak, will probably hurt the DAX, but we'll have to see obviously how they play out. But tomorrow will be centre stage, so I wouldn't pay too much attention into the data between now and then. Obviously the RBNZ we have to take a look at in the morning, expected to go on pause at 3 a.m. tomorrow morning, but we'll have a quick look at that on another video later on. But for now, US CPI in focus tomorrow. US dollars, or traders of US dollars, seem to be positioning themselves lower heading into that release. Bond traders seem to be bid on bonds as we head into that release. Is that a front runner for how this comes out? Obviously it remains to be seen. That's how traders are positioning themselves into tomorrow, but obviously we'll speak about that in a bit more detail as we get closer to the event.